the gold is there. I mean, people know that only about slightly less than half the gold, the U.S. gold, is in Fort Knox. The other half is at West Point in a vault in a secret location. I can't say where it is, but I know where it is. And then there's a little bit at the
You've
Denver.
seen it.
I know where it is, but it's
Okay.
classified, so I can't say more. But people know it's there, but they don't know where it is. But it's there. It's an army base. So all they're going to do, it's going to be a photo op. So
Yeah.
by the way, if you've ever held one of those bars, it's like freeways. They weigh about 25, 30 pounds, but they're going to hold the bars up. See, it's here. Show you some pictures and go away. That's not an audit, but it is like the mother of all photo ops.
President Donald Trump and Department of Governmental Efficiency, DOGE, Director Elon Musk have recently called for a full audit of the U.S. gold reserves at Fort Knox, sparking renewed discussions around the transparency and security of America's bullion holdings. Framed as a move for government accountability, the proposal has found support among free market skeptics concerned about the integrity of federal institutions and conspiracy theorists who believe the vaults contain little to no gold or even counterfeit bullion. However, the timing of this initiative raises broader questions about the role of gold in U.S. financial strategy. Speculation is growing that an audit could lead to a formal revaluation of the U.S. gold reserves, which are still valued at an outdated $42.22 per ounce, despite current market prices nearing $3,000 per ounce. The implications of such a revaluation could be far-reaching, not just for the Federal Reserve's monetary policy and inflation expectations, but also for the reserve status of the U.S. dollar. In recent weeks, physical gold and silver have flowed into COMEX warehouses in the U.S. at levels not seen since the early days of the COVID-19 pandemic. The London Bullion Market Association, LBMA, has experienced a significant drop in inventories, while soaring gold lease rates indicate a scarcity of deliverable metal, exacerbating the strain on global bullion markets. The shift in market behavior has intensified as traders holding long gold futures contracts have started demanding physical delivery instead of rolling over their positions, putting additional pressure on bullion banks to meet these obligations. Jim Rickards, a New York Times best-selling author, highlights that this trend has contributed to a self-reinforcing price rally, further driving the gap between futures and spot prices. As gold continues to flow into U.S. warehouses to offset shortages in London, speculative activity has increased, with hedge funds and momentum traders fueling price momentum. Given the potential for unpredictable policy changes under Trump and Musk's leadership, Rickards warns that a gold revaluation is worth considering. We present the clips of Jim's insights from his recent video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Gold might be affected by the tariffs. It's like Trump put these tariffs on. They applied to everything. Now he's creating carve-outs, as he said. The auto industry, they're getting a 30-day pause, but the tariffs are extremely broad, so they would apply to gold in the first instance, unless he carved it out, which he hasn't. Having said that, it won't have any effect on the global price of gold. The reason is that gold is kind of like oil, gold, a couple other things. These are global prices. They're produced all over the world, not everywhere, but in every part of the world. They're consumed in every part of the world, and they're easily substituted. So if the U.S. doesn't buy oil from Saudi Arabia, we don't buy that much from Saudi Arabia anyway. We can buy from Venezuela. If Canada cuts us off, we can buy more from Mexico or more from Venezuela. But the same is true of gold. The price is set in two places: the London Bullion Market and the COMEX, the New York Commodities Market. Physical prices and paper gold prices vary. There's a lot to it. But my point being, if there's a tariff on gold coming from Canada to the U.S., we'll just buy it in Shanghai, buy it from Africa, buy it from Switzerland. The point being, when a commodity is truly generic, a car is not generic. You get a certain brand and a certain set of features, and it's electric or hybrid or whatever. Cars are not generic. Gold is. It's an element, atomic number 79. So the point being, when you have a generic, fungible global commodity, tariffs don't affect the price, because if you're getting hit with a tariff, you just don't buy it from that source, you buy it from somewhere else. Now, getting back to your other point, Danielle, about shipments from gold, it does appear that there was some kind of short squeeze emerging. and that shorts were having trouble getting physical gold to satisfy deliveries. Now, that can only go so far. If you look at, say, how do you get short gold? You sell gold futures on the COMEX, 1 month, 2 months, 3 months forward, and then you get to the end of the contract, and the buyer says, "I would like physical delivery, please. I don't just want to pair off or roll over my contract. That's a paper transaction. That's the way most futures settle. But if someone long the future says, I'd like to take delivery, please, then yeah, you got to look at the warehouse and see what's there. And if there's not enough, you might have to get it from London or some other source. Now, that appears to account for some of the deliveries and some of the urgency about that. Having said that, there's a limit on that, and you have to read the COMEX rule book. I'm enough of a geek. I actually have read the COMEX rule book, but there are two important rules. Number one, they have a rule that says they can change the rules. So if things get tight or things get disorderly, they can just say sorry. No more physical delivery. We're trading for liquidation only. You can pair off your contract, roll it over, but you can't take physical delivery. They can just say that. And it is what they did to the Hunt brothers in 1980, I believe, 80 or 81, when they tried to corner the silver market. But there's another principle, which is also in the rule book, but it's just more broadly stated. Futures exchanges say, all of them say, we are not a source of supply. Now, it is true that you can provide notice and take physical delivery of the gold in a futures contract. That is true. But they only want a little sliver of that just to kind of keep the paper price and the physical price in line by linking it to the physical price through physical delivery. In some cases, there's a little bit of an arbitrage, but not much. It basically keeps those two prices in line. That's the purpose of it. If all the all the longs got together and all put in notice of physical delivery, I promise you, by noon that day, the COMEX would say, sorry, trade for liquidation only. You cannot take physical delivery. We are not a source of supply. So this notion, a lot of gold bugs have it, that somehow you could use the futures exchanges to break the market. No, you can't. Only to a point. So, and it may be. I haven't seen any evidence that gold was being shipped to beat the tariffs, and we haven't even put tariffs on the UK or Switzerland. We probably will, or at least the UK, but not yet. And so I think there might have been a mild short squeeze unfolding, and that accounts for the physical deliveries, but that's not going to go too far because the futures exchanges can shut it down. Too many futures longs, put in notice of delivery. The COMEX says, sorry, too many, we're not a source of supply, trade for liquidation only. Okay, so that puts out that fire. But if that was a real demand, then where are those buyers going to go? They're going to go to the physical market, and then that, basically London Metals Exchange and the London Ring, and that's where things could get very hairy very quickly. I've been talking a lot about this because Trump and Elon Musk are going to Fort Knox to prove that the gold is there. The gold is there. I mean, people know that only about slightly less than half the gold, the U.S. gold, is in Fort Knox. The other half is at West Point in a vault in a secret location. I can't say where it is, but I know where it is. And then there's a little bit at the Denver.
You've seen it.
I know where it is, but it's classified, so I can't say more. But people know it's there, but they don't know where it is. But it's there. It's an army base. So half is at West Point, half is at Fort Knox approximately, and there's a sliver at the Denver Mint for making gold coins basically. But that's it. So it's not all at Fort Knox, but they're going to go to Fort Knox, and they're not going to do an audit. I mean, to do an audit, you'd have these, you know what a gold bar, 400-ounce gold bar looks like. They all have serial numbers, assay stamps, refinery stamps, purity stamps, etc. You'd have to sit there with a ledger and take each number and compare it to the ledger, make sure they're all there, and adjust for the purity. Some of these bars, by the way, have been lying around since the 1920s. They're not 4.9s. They could be 97% gold. I'm not saying they're fake. I'm saying they could be 97, 98% gold. They're nowhere near 4.9s. 400 ounces, maybe. Some of them are a little gnarly. I'm not saying it's not there, and I'm not saying it's not real gold. It is. But if you're actually trying to price it out, you have to adjust for purity, weight, basically the things I mentioned. So all they're going to do, it's going to be a photo op. So,
Yeah.
by the way, if you've ever held one of those bars, it's like freeways. They weigh about 25, 30 pounds. But they're going to hold the bars up, see it's here, show you some pictures, and go away. That's not an audit, but it is like the mother of all photo ops.
After nearly 4 years of subdued interest, gold has once again captured the attention of investors, with gold-backed exchange-traded funds, ETFs, seeing significant inflows in February, according to the latest data from the World Gold Council. Near-record inflows into North American-listed funds largely drove the surge in investment demand. In total, 72.2 tons of gold, valued at $6.8 billion, flowed into North American ETFs. This marks the largest single-month inflow for the region since July 2020, and the strongest February on record, highlighting a notable shift in investor sentiment. The growing interest in gold is part of a broader trend of increased central bank buying, particularly from countries like Russia and China. Jim Rickards notes that central banks are now the primary drivers of gold demand, with Russia increasing its reserves fivefold over the past 16 years. This is partly driven by geopolitical instability and the desire to hedge against financial risks. While retail investors tend to wait for prices to rise to $4,000 or $5,000 per ounce before buying, central banks are strategically accumulating gold at more moderate prices. This long-term purchasing strategy, combined with the rising speculative demand, has contributed to the upward pressure on gold prices, ensuring the metal's continued relevance in global financial markets.
Retail is a little more active, you're right about that, but they're not really driving the market. In a panic, they will, but it'll be too late. I mean, it'll be, I was saying buy gold at 700, 1,300, 1,900, 2,000. It's now close to 3,000. People just don't do it. It's fine. I'm not in charge of their finances, but people just don't do it. The funny thing is, Danielle, this is just human nature. When it spikes to 4,000 or 5,000, then they'll run out and buy it. They could have had it at 1,300, but they'll wait until it spikes. That's just human nature. The big buyers are the central banks. They're the players. Some institutions, some hedge funds, but mainly the central banks, and we know who they are. It's Russia and China, but also Vietnam is a big buyer. I mentioned their trade surplus earlier. Okay, what are they doing with the money? Well, one of the things they're doing is buying gold. Kazakhstan, Turkey, Iran's buying it. They're non-transparent, but they're buying it, and Mexico and many others. So the central banks are driving. The inflection point was 2010. From 1970 to 2010, central banks were net sellers, but since 2010, they've been net buyers. But the amount of buying has been going up. I mean, Russia has increased their gold reserves by 5 times. And in 2009, they were 600 tons. Today, they're about 3,000 tons. That's a 5 times increase in, it's 16 years, but that's still 500% more gold. By the way, that gold has saved them in the Ukrainian war because the U.S. put financial sanctions and tried to steal $300 billion of U.S. Treasury securities that Russia paid for with dollars that they made by selling oil. When we froze the U.S. Treasury securities, and now we're in the process of stealing them, they stole $50 billion out of the $300 billion to make a loan to Ukraine. That's never going to get repaid. But Russia had put, Elvira Nabiullina, who's the head of the Central Bank of Russia, she had put 25% of their reserves in gold before the war in Ukraine, again, in this period since 2009. Now, here's one of the ironies that shows how much the U.S. doesn't understand about this. The war and the central bank buying and the kinds of things we've been talking about have driven up the price of gold so much that Russia has made $100 billion of profits on a mark-to-market basis on their gold. So, we froze $300 billion in Treasury securities, but they've been continuing to sell oil and natural gas, and they've made $100 billion on their gold, which thanks to us because we're the ones causing all the problems. So they're the driving force. Now, they have to be, Russia has been they've shown a lot of finesse in how they do it. They buy 10 tons a month, 20 tons a month. Some months they skip. Recently, they haven't reported anything. I don't think that means that they're not buying gold. I think it probably means they're buying the gold through the sovereign wealth fund instead of the central bank, which is what China does. China's been buying gold all along, but we don't really have hard data because they don't buy it through the central bank. They buy it through their sovereign wealth fund with something called SAFE, State Administration of Foreign Exchange. So they have these pockets where they can buy gold without putting it on the central bank balance sheet. But that's what's really driving the price of gold. And if you thought about it, you say, well, gee, why doesn't China just, announce what they're doing and, bid up the price of gold and make a lot of money? Well, the answer is they're not done buying. See, if you were buying, you wouldn't want the price to go up until you have all you want. When you have enough, that's different. But if you're still a buyer, you want the price to be moderate. So what's going on is a great game involving the major powers, involving gold. There's more to it, but that's what's driving the price higher.
Gold prices have risen more than 12% year to date, reaching record highs, driven largely by global uncertainty. In an environment where stability is less assured than in the past, investors increasingly turn to gold as a safe haven asset. One of the key factors influencing this shift is the imposition of tariffs, which are expected to have inflationary effects and disrupt global supply chains, adding to concerns over rising costs and economic slowdowns. Investors are also closely watching for potential retaliatory measures from impacted trading partners, which could further exacerbate market volatility. Although gold prices may experience short-term fluctuations, the metal's historical resilience and strong purchasing power in times of instability make it a reliable store of value, especially when currencies weaken. That's it for today. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video.